Hey, well, good afternoon and welcome. My name is Matt Price of the Price Group. We are certainly glad you are here joining us today. We'll be talking about for the next, call it 30 or 40 minutes, creating income for retirement. We think a lot of salient things that are different on creating an income versus just trying to grow a portfolio over your career. So, who are we? Randy, myself. Randy would try to tell you he is my older brother, but don't let him fool you. He is my father. Family owned and operated. We follow a fiduciary standard. We think that's important. Not everyone in our industry can say that. And we have a real niche in the retirement space. 83% of our clients are retired. So that is all we really do every day. A little bit about our firm. For those of you that might not be familiar, Steward Partners is based off the biblical definition of stewardship. Raymond James is one of our two custodial options. Custodian meaning that's where client assets are held. The other is Pershing. Two very good options that we do have. But it's been a good place for us, our clients, over the years. Randy's gotten quite a few awards, Barron's, Forbes, Financial Times over the years. I was humbled to get the Next Generation Forbes, I think it was Best in State Award this year. Randy and I both were certified financial planners. We both went to Wharton to get our CIMA, our Certified Investment Management Analyst designation. And if you followed us for any length of time, you've probably seen our Retirement Insider emails that we send out at least on a weekly basis. So here's what we're doing today. We're going to warm up our brain, just give a real kind of high-level overview of the markets, the top 5 risks of retirement, how producing income can mitigate these risks, and then we think how you can really live well in retirement. But there's dozens, if not hundreds, of reasons that y'all chose to join us today. And I see here a few familiar names, which we love. I see a few new names, which we also love. So please don't leave a stranger. If you do have any questions on this, reach out, let us know. We have a heart of a teacher, and our goal is we really want our clients to live well in retirement. But like I said, dozens, if not hundreds of reasons that you decided to attend. We think all those reasons really funnel to the same reason. Everyone's looking for comfort, confidence, and clarity as it pertains to their retirement and their financial future. And we don't have a genie in the bottle where we know all the answers, but what we do have is a bona fide and time-tested strategy to help families plan for and also walk through the complexities of retirement. So let's warm up our brain here. What was the annualized return of the S&P 500? Many consider to be the stock market best index to follow for U.S. stocks in the 1930s. Is it A, 0, B, -3%, C, -7%, or D, 2% per year? Drum roll, please. And the answer is actually 0.0. So we call that a lost decade in stocks. More recently, from about 2000 to 2010, was also near a lost decade in stocks, with stocks being down in 2000, 2001, 2002, and then we all know what happened in 2008 as well. So, quick overview. We love this quote by Yogi. It's tough to make predictions, especially about the future. We're not in the business of making predictions. We want to set clients up for, I like to say, use Wayne Gretzky. He was a great hockey player, not because he skated to where the puck was, but he said he was great because he skated to where he thought the puck was going to be. And a lot of similarities there to be a good investor in retirement. We don't want to necessarily create a portfolio for what's going on today. We're more interested in what do we think is going to happen 3, 6, 9, 12 months from now. But like Yogi said, we don't know, and we think income is a way that we really put the law of large numbers in your favor. So here's a chart we're looking at dating back to before 1900 through it looks like last year. Green is good, red is bad. Green are the bull markets. And what we want to draw your attention to here is bull markets actually, they tend to last for 15 to 20 plus years. And so we are of the opinion that we began a bull market in the spring of 2009. Obviously, there's been a few hiccups along the way. COVID, there was a sharp pullback in 2020. Last year, the S&P 500 was down 18, 19, 20% using round numbers. But we think there are a few innings left in this bull market. So that's kind of our big picture look at the market. And we'll get into some of the details later. But the second slide, kind of on the fixed income side, safe bonds. And we say safe in italics. Here are a couple different periods of time broken out in 20-year increments on how bonds perform. And what I want to draw your attention to is the second, the third, and the fifth box. So 3 out of the 5 periods, the T-bonds and the T-bills actually had negative rates of return. And you say, well, how is that? These are what we call real rates of return that are adjusted for inflation. And so once you take inflation into account, you actually are backing up. Last year was obviously a real poor year to be a bond investor. What we think is important to take from this slide, though, is times are a-changing. And we think there are a number of different strategies to consider in the fixed income world. We don't think it's a world where you can own just a kind of diversified bond mutual fund and right off into the sunset, because what you've had really dating back to the early 80s up until the end of, call it 2021, interest rates just moved lower. And as we all know, there's that inverse relationship. So when interest rates go down, bond prices come up, but when interest rates come up, the bond prices go down. And so we don't think you're going to have this tailwind effect for the next 20 or 30 years like you've had for the last couple of decades to move bond prices in your favor. So what are the top 5 risk of retirement? This is not a comprehensive list, but we would say these are the 5 risks that we think you should be considering. The first being longevity. Here are a few of the statistics of how long a married couple is expected to live. The old saying, the longer you live, the longer you're expected to live, is very true. This is, if we look here out to, let's call it age 90, just having one of the spouses living to age 90, there's a 47% chance of that. And that number actually keeps slightly increasing every year, just with medical advances, etc. So we want to make sure we plan past life expectancy, if you're asking our humble opinion, when doing some type of retirement planning. And we'll talk a little bit more about what our retirement plan looks like later. The second risk is inflation. We think inflation in retirement really is a hidden tax. If you're not familiar with the rule of 72, you can take 72, divide it by the rate of inflation, and it tells you approximately how long it will take your cost of living to double. So let's take 3% inflation. 72 divided by 3 is 24 years. Take your cost of living would double every 24 years with 3% inflation. But what if inflation clicked up to 6%? Well, your cost of living would double every 12 years. So we've had a number of families actually retire, one in their 40s this year, which is pretty young for our client base. We've had a few couples retire in their 50s. These couples could see inflation double, if not triple, what their current cost of living is. So they could see 2, 3 doubles, given the fact that they're going to be retired, hopefully, for 35, 45 years. So once again, inflation in retirement, we think really is a hidden tax. 2 slides here on market performance. And we go over this in detail when we go through our Live Well plan, but I'll give us kind of just the highlights here. The two boxes on the left represent the accumulation phase. And so if you're still working, adding money to your 401k, not taking money out of a 401k or IRA to supplement your lifestyle, you're in the accumulation phase. And suffice to say, the order in which you get your returns, assuming all the returns are the same, the order you get them matters not. And so you can compare the top left box here with the bottom left box. Same returns, but the top left box, you get a negative 15% rate of return in year 1, 7% years 2 through 9, and you end it with a great year, up 29% in year 10. You start with $100,000, you get to the exact same place if you reverse those returns and get the good return up front, the bad one in the 10th year. However, that's a stark contrast to the distribution phase, which is retirement. And the order of which you get your returns is very, very, did I say very important, where bad years early in retirement are much more prohibitive to your long-term success than having some good years in the first few years of retirement. Long way around the barn of saying we don't think an Excel spreadsheet is adequate for your retirement planning. What we use and what we recommend is Monte Carlo simulation. It's probably a term that is familiar to most of you, but we're going to show you going through retirement 1,000 times, okay? And we're going to use the probability of success based off those 1,000 trials using just this, the randomized returns, to make sure that we are optimally taking the right money out, investing a portfolio in what we think is the most appropriate way for your family. So to continue on the third risk of market performance, I would say intuition tells us if you start with $100 in your retirement portfolio and you're down 20%, you lose $20, it takes another 20% to get back to break even, back to your original 100. But that's just not the case, and it's really you can see that with real clarity when you're taking money out of a portfolio. So if you're down 20%, you have inflation of 3%, and you're taking 4% out of the portfolio per year, you actually need 36% just to get back to break even. So one of the real ways to win in retirement is just not to lose. And we think that should be a real philosophical shift from growing money to how do we protect and preserve money. And so when we look at a stock portfolio, that's really what we're thinking about, is how can we have some type of downside protection when compared to the overall market, just from a standpoint, we know that it's going to be a bumpy ride, and we want to take less risk on the downside just because it's harder to claw back to get to that break-even number when you are taking distributions. The fourth risk that we wanted to go over, investing without a process. There are dozens, if not hundreds, of books out there written about how emotions really get the best of you in bad times, and how all humans tend to not make the best decisions when we are emotional. And so this grayish black line is actually the S&P 500, and the two little red boxes there are the periods where the most selling happened across U.S. mutual funds and also ETFs. And you can see the years down there at the below. It's at the end of 2002, and then towards the end of 2008, early 2009. Arguably, the two worst periods in time to sell your stocks were when the most people sold their stocks. And so with that being said, we think a big part of going into retirement is having a bona fide plan of what you're going to do, not if there is another economic storm or market turbulence, but we know there is going to be that economic storm or market turbulence. How are we going to respond? And so controlling emotions is a big part of that. And then The last risk we want to kind of touch on today before we go into how we're going to face these uncertainties is healthcare. There was a recent poll out, and I think it was over 90% of the people out there underestimate how much they're going to spend in retirement on healthcare costs. And these healthcare costs don't necessarily even include potential long-term care costs down the road. So bottom line is this: we need to make sure we plan for these expenses. When we put together a Live Well plan for people who are kicking the tires, we will have a line item for your basic living expenses. And then in a separate line item, we will have all your medical expenses. And this includes estimated Medicare premiums, copays, out-of-pocket deductibles, any secondary private insurance that you have, or something that you've gotten through your former employer. So we want to make sure that we take these into account. We also like to take, for certain families, long-term care into account as well, just based on extenuating circumstances. So, Matt, wow, it is 3:16. You spent 16 minutes, and most of that is really negative news. Well, what are we going to do about it? Like I said, we don't have a crystal ball, but here's what we think you should consider doing about it. The first step is creating a retirement roadmap. We call our retirement roadmap a Live Well plan. We call it that because we're kind of cheesy and we couldn't come up with a better name, but deep down, we really want our clients to live well. And so this is not a check the box, put it in your proverbial filing cabinet, and never look at it again. This is something we're updating for clients year over year and helping them answer the question: are we ahead of track? Are we behind track? Or are we right on track? And we think this is really one of the keys to a successful retirement, is having a bona fide written down plan that helps you determine how much you can spend in retirement to allow you really to enjoy that more moving forward. Second step, stress test your portfolio. We were really pounding the tables before 2022 on this, and a lot of clients woke up, or not clients, a lot of people we were talking to woke up and realized that they were taking a lot more risk than they really realized. And so it sparked a lot of people to reach out to us that were not clients to kind of have that conversation. Hey, let's look at this in more detail. But we think the closer you get to retirement, the more you need to know what you own and why you own it. Where if you're 32 and the market has 25% pullback, you're kind of like, it's not going to affect my lifestyle. I'm not retiring for another 20, 25, 30 years. But if you're 58 and a half looking to retire at 60, having a substantial market pullback could affect your timing. And so we think stress testing your portfolio is a wise consideration for your family once you get inside that 3 to 5 year period of retirement. Maximizing Social Security benefits. There are over 80 ways for a married couple to file for Social Security benefits. This, there on the right-hand screen, you used to get a really nice quarterly statement from Social Security. A few years back, they did away with that. Now they're online, but statements are not the same, but they're similar. And we think that this is a huge thing for each family to look at in their own unique way. If there's a blended family or a second marriage, sometimes that 80+%, that 80 ways that you can take it as a married couple actually is amplified. So Social Security can get complicated really quick. We partner with a Social Security expert when it does get really into the weeds. We like to say, think of us as a general practitioner. We know when we need to refer people to a specialist, but at the same time, we know enough to kind of get our hands dirty and help make some good, wise decisions as it pertains to your Social Security benefits. The fourth step, promoting income tax efficiency. When you reach that age of 85, 90, 95, and you're looking back at your life, I'd be hard pressed to say that the biggest expense of your lifetime is going to be income taxes. So thank you to each one of you who are paying those taxes. Y'all are great Americans. But what we want to do is we want to look for ways to reduce the overall lifetime tax bill. And we're not CPAs, we don't provide tax advice, but we've been around the block a few times to where there are ways where we can hopefully reduce that lifetime tax bill. And so just for a few ideas, this is not by any means holistic, but just we wanted to list a few gifting ideas. Your qualified charitable distributions, QCDs, starting at age 70 and a half, you're allowed to take out part of your IRA up to $100,000 and give that directly to a charity. Once you reach age 73, it counts towards your required minimum distribution that you're required to take out, and you're not taxed on that money. So that is one of the best ways, if you are charitably inclined, to give once you reach at least 70 and a half. Gifting appreciated stock is another great way to sidestep some capital gains. If you had, let's use any one stock as an example, and you bought a stock at $100 a share and it's grown to $300 a share, you can give that stock to a charity, get the tax write-off at $300 a share, assuming it's a 501c3 qualified charity. They sell it in their own account, and there's no tax implications for them to do that. And then bunching deductions, the standard deduction has increased so much that a lot of families are just using the standard. So we've seen a lot of clients, maybe it's odd years, you're using the standard deduction, even years, you're itemizing, paying that property tax maybe in December for the previous year, and then paying the next one in the same calendar year to kind of bunch those together. From a standpoint, it can help you out a little bit on just every other year trying to itemize. The fifth step, cash flow planning. And we say, is 3% the new 4%? Time will tell, but what we're looking at here are distribution rates with a starting portfolio of 500,000. And it's become a little bit harder to take 4% out of a portfolio, depending on what age you're retiring. That's a key consideration. Just based off the fact interest rates are still lower than they were in the 70s, the 80s, the 90s. So we'll hear some people say, well, Matt, Randy, what's the difference in 4 and 5%? It's only 1%. While they're not wrong, going from 4 to 5 is obviously a 25% increase. So it's a material amount over your lifetime. And this is a big part of our Live Well plan is, hey, let's plan out how much money we think you can spend year over year when we factor in any potential inheritance goals, when we factor in gifts, when we factor in basic living expenses, healthcare, go down the list. But this is, we think, one of the real keys where we need to roll our sleeves up and do some serious homework prior to your retirement. Income-oriented investments. Dividends are something that you're hearing talked about a little bit more and more on CNBC. Not that we think that is necessarily a great place to get your investment advice, but we've been talking about dividends for years. Randy likes to say he was country before country was cool. But this is a look at back by decade of what the dividends contributed to the overall return of the stock market every 10 years. And overall, right around approximately 40% of that total return comes from dividends. So it's not a rounding error. Dividends have really been a huge part of returns when we go back the last 80, 90 years. And for a retired family, we want to lean on that dividend to help us produce the needed income for those monthly expenses in retirement. So with that being said, we don't think all dividend stocks are created equal. What we're looking at here is a chart where we're focused actually on companies that not only pay dividends, but grow their dividends year over year. And there's evidence to suggest that companies that can grow their dividends year over year are typically the most healthy companies that typically have the most gain on average with their stock prices over, this study was done from 1986 through the end of last year. And you can see the results. Both dividend stocks and dividend growth stocks outperformed the overall market, but the dividend growers were the leaders in the clubhouse. And then step 7, planning for long-term care. I mentioned this earlier. Here are a few numbers that are a little bit dated. The numbers have gone up, but these are good ballpark figures. And really the average cost, it depends, depends a whole lot on what part of the country you live in. Are you going to have a facility in really the heart of Houston? Is it out in the suburbs, or are you in a different, smaller town? Obviously, different markets call for different prices on things of this nature. But let's plan for this. And if you don't have long-term care insurance, what we typically are going to recommend is that we illustrate the sale of your house. So using your home equity as a means to pay for this, if this is an expense that would be needed later in life. And here's our 8th and final step. We think it's prudent advice to consider hiring an advisor. And why, I think, is a fair follow-up question to that. You can see here the average advisor has drastically underperformed their house, bonds, stocks, high yield bonds. You can see it right there over the last 20 years, ending 2020. Every year, the study's updated and the numbers don't change a whole lot. But on top of that, a lot of families, it makes sense to have some alternative investments, some individual bonds. But as you get closer to retirement and enter retirement, mistakes really become more costly. And that's something we do want to avoid. We've helped hundreds of families walk through retirement. We know where the potholes are. We know where you can sprain your ankle, where you can stub your toe, proverbially speaking, and we do our best to keep clients away from making those mistakes. So there's a lot of people out like us in the city of Houston. We realize that. We think our plan is unique for a few reasons. Number one, a lot of people just focus on helping with your bond, your stock, your mutual fund portfolio. And we do that as well. We think we have a track record that we can back up, that we're pretty good at that. But we think the real value add that you should be considering if you are interviewing advisors is, are they holistic? Are they creating a plan that takes really everything into account? And so that's how we look at the world. If you do want to kick the tires, we put together what we call our Live Well plan. There's no cost or charge to do that. And we're going to gather and kind of pull everything in for your financial life. Warren Buffett's mentor, Benjamin Graham, has a great quote: "The best way to measure your investing success is not whether you're beating the market, but by whether you've put in place a financial plan and the behavioral discipline that are likely to get you to where you want to go." And so our attempt to really live out that quote is our Live Well plan. And a part of our Live Well plan is developing what we call our family index number. This is the rate of return we think you need on average to be quote unquote successful through retirement. Now, some years will probably outperform this figure. Other years will underperform this. So this is not a guarantee. This is not a cap on the upside. But over that 10 to 15 year period, we want this to be our average rate of return. And what we're solving for is we want to take the least amount of risk possible for you to meet your goals. And you say, well, why would we want to do that? We mentioned earlier, we think in retirement, one of the best ways to win is just win by not losing. And so we don't think you necessarily need to take this big amount of risk just to grow your portfolio quicker. You're really introducing a lot of different risk at that point, which you may or may not need depending on your personal situation. So we would love to create a live well plan for you. Randy jokes that he's an old Baptist pastor, has all these the C's, he calls them: comfort, confidence, and clarity. And so that's our goal when we're creating a live well plan for a family, is we want them to walk to the car and kind of give this deep sigh of relief where they've seen everything pulled together, possibly for the first time. We're not salesmen. We're not going to try to sell you something while you're here. Like I said earlier, we have the heart of a teacher, and we do our very best to try to help educate you more on your own personal situation. So our promise is this: if you do want to schedule a meeting, you'll leave a more educated consumer on your own situation. We end up working together, that's great. If not, we can shake hands and part as friends. But a few things we think you should consider if you are interviewing advisors. Number one, are they a fiduciary? I said earlier, not everyone in our industry can say that. Number two, do they have experience? Are there certified financial planners on the team? How many years have they been doing this? I think a key thing to consider is how old is the advisor? You typically don't want to hire an advisor that's older than yourself. If you do, you want to have someone also on the team that is younger, has been there for a while, and there'll be a seamless transition when that does happen. There are a lot of generalists in our industry. We're not a generalist. We consider ourselves a specialist in retirement. I mentioned earlier, over 80% of our clients are retired. And then, is there a cookie cutter type of approach? Are you just a number to them, or are they looking to create a real personal relationship? And that's where we stand on the personal relationship side. Typically, when clients hire us, they don't fire us, and we work with families really through the duration of their retirement. It's been a real joy to get to meet their kids and actually some grandkids of clients who've been clients for a long time. And then, can you understand what they're saying? Does the advisor communicate well? We have a guide on this. If you're interested in seeing our guide, shoot me an email. I'm happy to send that to you. But as for Randy, myself, that's Maddie, Tiffany, and Melissa. Want to say thank you for coming. We were just right on time, 32 minutes. I know that we kind of flew through a lot of items, but please do this. If there are any questions, pick up the phone, give us a call, shoot us an email. We would love to put together a live well plan for you. I know a few of you on this call, we've already done that. It might be time to knock the dust off and update some of those numbers and take a second look at it as you do get closer to retirement. But once again, thank you for coming, and we hope you have a good rest of the Tuesday. Take care.